Before we dive in, please remember that I am not a financial advisor or a licensed insurance agent. This video is for educational and informational purposes only and should not be considered financial, legal, or medical advice. The world of health insurance is complex and changes frequently, so always consult with a qualified, licensed professional before making any decisions about your specific situation. You did it. You finally quit the 9-to-5. You are your own boss. The freedom is intoxicating until that first letter arrives. It's from Cobra, the program that lets you keep your old employer's health insurance. You open it and your jaw hits the floor. It's $1,000 a month, $1,500, maybe even $2,000. Suddenly, that freedom feels like a golden cage. The biggest question in your life is no longer, how do I get more clients? It's, how on earth can I afford to get sick? You're not alone. This is the moment every new freelancer, consultant, and small business owner in America dreads. It's a baptism by fire into a world of bewildering complexity, a world your friends with corporate jobs simply don't understand. They have an HR department. They have a neat little packet of 3 pre-selected options given to them once a year. You have the entire internet. You have a government marketplace with 100 different plans, each one a wall of indecipherable text and terrifying numbers. Deductible, coinsurance, out-of-pocket maximum. It feels like a different language, a language designed specifically to confuse you into making a catastrophic mistake. And the stakes couldn't be higher. Pick the wrong plan, and you're either bleeding money every single month on a premium you can't afford, or you're one accident away, one broken leg, one sudden illness, from watching a decade of savings evaporate into a black hole of medical debt. That fear is paralyzing. It keeps you stuck, endlessly comparing plans, terrified of clicking the enroll button because you're convinced you're missing something, that there's a secret trap hidden in the fine print. But what if I told you there's a system, a step-by-step framework that can cut through all that noise, demystify the jargon, and empower you to find the perfect health insurance plan for your specific needs, without overpaying a single dime? What if you could look at any plan and, in less than 60 seconds, know with absolute certainty whether it's a good fit for you, your family, and your business? That is the promise of this presentation. Over the next several minutes, we are going to dismantle the entire process of finding and choosing self-employed health insurance. I'm going to give you the exact knowledge and tools you need to transform from someone who is overwhelmed and confused into someone who is confident, in control, and completely protected. We'll cover how to navigate the marketplace, the secret tax deductions almost every freelancer misses, and the powerful alternative options that exist outside of the standard system. By the end of this, you will not only have a plan, you will have a strategy. You will never feel powerless in the face of the healthcare system again. So let's start with the absolute foundation. Before you can even begin to compare plans, you have to understand the 4 numbers that control everything. If you don't understand these 4 pillars, you are flying blind. They are the language of insurance. Get these and everything else clicks into place. These 4 numbers are your premium, your deductible, your coinsurance, and your out-of-pocket maximum. Let's break them down one by one in plain English. First, the premium. This is the easy one. Your premium is the fixed amount of money you pay every single month to keep your health insurance active. Think of it like a subscription. It's your Netflix bill, your gym membership. You pay it whether you use the service or not. It's the cost of entry. If your premium is $500 a month, you will pay $6,000 over the year just to have the insurance card in your wallet. This is the number most people focus on because it's the one that hits their bank account every month. But focusing only on the premium is one of the biggest and most costly mistakes you can make. Which brings us to pillar number 2, the deductible. This is the big scary number that prevents most people from ever using their insurance. The deductible is the amount of money you must pay out of your own pocket for covered medical services before your insurance company starts to pay anything at all. Let's say you choose a plan with a $5,000 deductible. If you fall and break your arm, and the hospital bill is $7,000, you are responsible for paying the first $5,000 of that bill yourself. Only after you have paid that $5,000 will your insurance begin to contribute. Until you've met your deductible, your insurance is basically just sitting on the sidelines. This is a critical concept. A low premium plan often looks attractive, but it usually comes with a massive deductible. You might be paying only $300 a month, but if you have an $8,000 deductible, you'd need a major medical event to ever get any real financial help from your plan. Now, once you've paid your full deductible, everything is free, right? Wrong. And this is where our third pillar comes in, the one that trips up almost everyone: coinsurance. Coinsurance is the percentage of costs you share with the insurance company after you've met your deductible. It's usually expressed as a ratio like 80/20ths or 90/10ths. The first number is what the insurance company pays, and the second number is what you pay. Let's go back to our broken arm example. The bill was $7,000, and your deductible was $5,000. You've paid the first $5,000. Now there's $2,000 left on the bill. If your plan has an 80/20ths coinsurance, your insurance company will pay 80% of that remaining $2,000, which is $1,600. You are responsible for the other 20%, which is $400. So your total cost for that broken arm isn't just your $5,000 deductible. It's $5,000 plus $400, for a total of $5,400. Coinsurance is the phase where you and the insurance company are partners in paying the bills. You're not on your own anymore, but you're not off the hook either. This sounds like it could go on forever, right? What if you have a truly catastrophic year with hundreds of thousands of dollars in medical bills? Are you just stuck paying 20% of that indefinitely? No. And that brings us to our fourth and final pillar, the most important number on the entire plan: the out-of-pocket maximum. This is your financial safety net. It is the absolute total most you will ever have to pay for covered medical services in a single year. Period. Once you hit this number, the insurance company pays 100% of all covered costs for the rest of the plan year. This number includes everything you've paid: your deductible, your co-payments, and your coinsurance payments. It all adds up and counts toward this magical ceiling. So, if your plan has an out-of-pocket maximum of, say, $8,700, that's your worst-case scenario. No matter what happens, no matter how many surgeries you need or how complex your treatment is, you know that your financial liability for the year is capped at that amount. This is the number that protects you from bankruptcy. When you're evaluating a plan, you have to ask yourself, if the absolute worst happened, could I afford to write a check for this out-of-pocket maximum? If the answer is no, that plan is too risky for you no matter how low the monthly premium is. Premium, deductible, coinsurance, and out-of-pocket maximum. These are the four pillars. They are a balancing act. A plan with a low monthly premium will almost always have a high deductible and a high out-of-pocket maximum. A plan with a high premium will have lower ones. There is no perfect plan. There is only the perfect plan for you, for your health needs, your risk tolerance, and your budget. Now that you understand the fundamental language of every health plan in America, you have the power to compare them intelligently. You can finally see past the marketing and understand the true financial structure of each option. But knowing the words and knowing the game are two different things. It's like learning the names of all the chess pieces: pawn, rook, knight, but having no idea how to pull off a checkmate. So let's play the game. Let's walk through the single most important decision you'll make right at the start. A decision that will define the entire experience of your healthcare for the next year. To do this, I want to introduce you to someone. Let's call her Sarah. Sarah is a freelance graphic designer. She's brilliant at what she does. She left her corporate job 2 years ago, and after a rocky start, her business is finally thriving. She's landing big clients, her income is stable, and she loves the freedom of being her own boss. But there's a dark cloud on the horizon. The COBRA coverage from her old job is about to expire. In 30 days, she'll be on her own, and she is terrified. She opens her laptop and types "health insurance for freelancers" into a search bar. Instantly, she's drowning in an alphabet soup of acronyms. HMO, PPO, EPO, POS. Feels like a trap. She thinks, if I choose the wrong one, am I going to go bankrupt if I get sick? Will I be denied care? Will I be stuck with a doctor I hate? This is the first and most fundamental crossroad every self-employed person faces. It's not about a specific company like Blue Cross or United Healthcare. It's about the type of plan, the very architecture of how you will access and pay for your medical care. This choice boils down to a classic trade-off: cost versus control. How much are you willing to pay for the freedom to choose your doctors and hospitals? Let's help Sarah break it down, starting with the most restrictive, but often most affordable option, the HMO. HMO stands for Health Maintenance Organization. Think of an HMO as a fortress with very high walls. Inside the fortress is a specific curated network of doctors, hospitals, and specialists who have all agreed to provide services for a set price. The main rule of the HMO fortress is simple: if you want your insurance to pay for anything, you must stay inside the walls of the network. If you go to an out-of-network doctor, except for a true life-threatening emergency, you pay 100% of the bill. The insurance pays nothing. But there's another catch. To even move around inside the fortress, you need a guide. This guide is your primary care physician or PCP. You must choose one when you enroll. Your PCP is your gatekeeper. Feeling sick? You see your PCP first. Need to see a specialist like a dermatologist or a cardiologist. You can't just book an appointment. You have to go to your PCP and get a referral, which is basically a permission slip to see that other doctor. Your PCP literally coordinates all of your care. For Sarah, the freelance designer, this sounds incredibly restrictive. Why would anyone choose this? The answer is cost. Because HMOs have so much control over which doctors you see and what services you get, they can negotiate very low prices. This translates into lower monthly premiums for you. The costs are also highly predictable. Since everything is managed in a network, you're less likely to get hit with a surprise bill from an out-of-network anesthesiologist you never even met. An HMO could be a great fit for Sarah if she's relatively healthy, doesn't have complex medical needs, and is looking for the lowest possible monthly payment. If she's comfortable building a relationship with a single primary doctor and doesn't mind the referral process, the HMO offers a structured, budget-friendly way to stay insured. But what if Sarah values flexibility above all else? What if she has a specific specialist she's been seeing for years and doesn't want to give them up? This brings us to the second major option, the PPO. PPO stands for Preferred Provider Organization. If the HMO is a fortress, the PPO is an open-world adventure game. You have a home base, the preferred network of doctors, where your costs are lowest. But the key difference is you have the freedom to travel outside that home base. You can go see an out-of-network doctor or visit a specialist whenever you want, without a referral from a primary care doctor. You are in the driver's seat. This sounds amazing, right? Total freedom. But freedom always comes at a price. First, the monthly premiums for PPO plans are almost always significantly higher than for HMOs. You're paying for that flexibility every single month whether you use it or not. Second, when you do go out of network, your insurance doesn't cover as much. For example, your plan might cover 80% of the cost for an in-network specialist, but only 50% for an out-of-network one. This means your coinsurance is higher. And crucially, your deductible and out-of-pocket maximum are often much higher for out-of-network care. You might have a $3,000 deductible for in-network care, but a separate $10,000 deductible for any out-of-network services. You have to meet that higher deductible before the insurance starts paying its 50% share. So for Sarah, the question is, how much is that freedom worth? A PPO is a fantastic choice if she travels frequently and wants coverage across the country, if she wants to continue seeing a specific doctor who isn't in many networks, or if she simply wants the peace of mind that comes with being able to see any specialist at a moment's notice without needing a referral. She's paying a premium for ultimate control and choice. Now, Sarah is starting to see the spectrum. On one end, the HMO low cost, low freedom. On the other end, the PPO high cost, high freedom. She thinks, isn't there something in the middle? And there is. This brings us to the third, an increasingly popular option, the EPO. EPO stands for Exclusive Provider Organization. This one is a hybrid and it's a bit tricky, so pay close attention. An EPO tries to give you the best of both worlds. Like a PPO, it gives you freedom within the network. You generally do not need to choose a primary care physician, and you do not need a referral to see a specialist. If you want to see a dermatologist, you just make an appointment with one. That's the PPO-style freedom. However, and this is the critical part, like an HMO, it has high fortress walls. There is absolutely no coverage for out-of-network care, except in a true emergency. An EPO gives you the freedom to roam, but only within a designated, exclusive territory. For Sarah, this could be the sweet spot. She gets the lower premiums that are more comparable to an HMO, but she gets the freedom of not needing a gatekeeper PCP or referrals. She can manage her own care. The massive risk, however, is the network. She has to be absolutely certain that the doctors and hospitals she wants to use are all inside that exclusive network. If her preferred therapist is in network but the hospital closest to her home is not, the EPO could be a dangerous choice. It offers a fantastic balance of cost and freedom, but it requires you to do your homework on the network before you sign up. Finally, there's one more you might see, though it's becoming less common: the POS or Point of Service Plan. A POS plan is like a weird cousin of the HMO. It's structured like an HMO, meaning you still choose a PCP, and that PCP acts as your gatekeeper for referrals. But it gives you the option to go out of network for care, usually at a higher cost, much like a PPO. It's an HMO that gives you an escape hatch, but you have to pay a toll to use it. So now the alphabet soup is starting to look like a real menu for Sarah. She's no longer just staring at random letters. She's looking at 4 distinct philosophies of healthcare. The HMO, the structured, budget-friendly guardian. The PPO, the flexible, freedom-focused explorer. The EPO, the modern hybrid that balances cost and in-network freedom. And the POS, the old-school diplomat with an escape plan. The choice she makes here will dictate everything. It will determine which doctors she can see, how much she'll pay out of her own pocket, and how much administrative hassle she'll have to deal with. It's a decision based on her personal health, her tolerance for risk, and most importantly for a freelancer, her budget. But understanding these plan types is only the first step of the journey. Now that Sarah knows what she's looking for, she faces an even bigger, more confusing question. Where on earth does she go to actually buy it? Does she go to the government's healthcare.gov website? Does she find a private broker? Can she just call up an insurance company directly? Each path has its own hidden advantages, secret trapdoors, and critical financial implications, especially for the self-employed. And that is where we are going next. So let's follow Sarah as she stands at this critical fork in the road. In her mind, the most direct route seems to be the simplest. Just go straight to the source. She thinks, I'll cut out the middleman and just call a big insurance company directly. This is the do-it-yourself approach. Feels empowering, like you're taking control. You go to the website of a major carrier. Let's call them Patriot Health. And you're immediately faced with a wall of options. Bronze, silver, gold, platinum. PPO, HMO, EPO, POS. It's an alphabet soup of acronyms designed to confuse. For Sarah, this is instant overwhelm. She sees HMO and PPO and her eyes glaze over. But the difference is actually critical. Think of it like this. An HMO, or health maintenance organization, is like a curated, all-inclusive resort. You have a specific list of doctors and hospitals you can use, the in-network providers. To see a specialist, you usually need a referral from your primary care physician, who acts as a gatekeeper. It's structured, it's often cheaper, but it's restrictive. A PPO, or preferred provider organization, is more like a travel voucher you can use almost anywhere. You have a network of preferred doctors where your costs are lower, but you have the freedom to go out of network to see any doctor you want without a referral. That freedom, of course, comes at a much higher price, both in monthly premiums and out-of-pocket costs. Sarah, trying to be a savvy business owner, thinks the cheaper HMO might be the way to go. She starts filling out the application on the Patriot Health website. They ask for her name, her address, her age. But then she hits a wall. The website gives her a price, a final number for her monthly premium. And it's high. It's a gut punch. What the Patriot Health website doesn't ask, and what it's not designed to help her with, is the single most important question for a self-employed person. What's your estimated income? And right there is the hidden trapdoor of the DIY approach. When you go directly to an insurance company's website to buy a plan, you are buying what's called an off-exchange plan. You are completely bypassing the system set up by the Affordable Care Act, or ACA. This means you are walking away from potentially thousands of dollars in government assistance. You are telling the government, no thanks, I don't need any help, without even knowing if you qualified for it in the first place. For a freelancer like Sarah, whose income is a roller coaster, this is a catastrophic financial mistake. She's leaving a massive pile of money on the table, and she doesn't even know it's there. Frustrated and a little defeated, Sarah considers her second option, finding a private broker. This feels intimidating. It sounds expensive. A broker sounds like something for a big company, not a one-woman graphic design shop. But here's the secret the insurance industry doesn't exactly advertise. Using a licensed health insurance broker is almost always completely free to you. Their commission is paid by the insurance company after you enroll in a plan. The price of the plan itself is legally fixed. It will cost you the exact same amount whether you spend 10 hours figuring it out yourself or have an expert guide you through the process for free. Think of a broker as a personal shopper for your health. Their job is to work for you, not for a single insurance company. A good broker is carrier agnostic. They don't care if you choose Patriot Health or American Wellness or any other company. Their goal is to find the best fit for your specific needs. So Sarah finds a local independent broker. The first thing the broker does is sit down and just talk to her. Not about plans, but about her life. They ask, what's your business? Do you have any chronic conditions? Are there specific doctors or hospitals you absolutely want to keep? What's your risk tolerance? How much can you realistically afford to spend each month? And how much could you handle in a worst-case scenario? This is a completely different experience. Instead of being a nameless applicant on a website, Sarah has an advocate, a translator for all that confusing jargon. The broker can lay out the plans from 5 different companies side by side and explain the real-world difference between a $5,000 deductible and a $9,000 deductible. They can point out the subtle network differences like, this cheaper plan is great, but just so you know, the top-rated cancer center in your city isn't in its network. That's information Sarah would have never found on her own until it was too late. But the most valuable thing the broker does is introduce Sarah to the third path, which is really the master key to everything, the official health insurance marketplace. This is the government-run platform. Most people know it as healthcare.gov. Think of it as the Amazon for health insurance. It's the only place where you can get financial help from the government to lower your monthly costs. This help is called the Advanced Premium Tax Credit, or APTC. It's a subsidy, and this is where it all clicks for Sarah. The broker explains that their first step is always to see if a client qualifies for a subsidy on the marketplace. They don't even bother looking at those off-exchange plans unless the client's income is too high to qualify for help. Here's how it works in the simplest terms. The government looks at 4 things: your estimated income for the coming year, your zip code, your age, and your household size. Based on that, they determine the price of a standard benchmark silver plan in your specific area. Then the ACA says that you should not have to pay more than a certain percentage of your income for that benchmark plan. For 2024, that percentage is on a sliding scale, but for many people, it maxes out at 8.5% of their household income. So, let's say the benchmark plan in Sarah's area costs $500 a month. But based on her estimated income, the government says she should only have to pay, say, $200 a month. The government then gives her a tax credit, a subsidy, for the $300 difference. And she can use that $300 credit to buy any plan on the marketplace, not just the benchmark one. She could get that silver plan for $200. She could get a less expensive bronze plan for next to nothing. Or she could apply that $300 credit to a more expensive gold plan to lower its cost. Suddenly, health insurance goes from being a crippling expense to something that is actually manageable. The broker, using their expertise, can navigate the marketplace website, help Sarah create an account, and accurately input her information. The broker path and the marketplace path aren't separate choices. A good broker is your expert guide through the marketplace. They unlock the door to the subsidies that Sarah never would have found on her own. She feels a wave of relief. This is the answer. This is the path forward. She has a guide, she has a map, and she sees a destination that doesn't end in bankruptcy. The broker smiles, pulls up the final application, and then asks Sarah the one simple question that is the stuff of nightmares for every self-employed person in America. So what do you project your modified adjusted gross income to be for next year? And her heart sinks. Project her income? She barely knows what she's going to make next month, let alone over the next 12. She's a graphic designer. Some months she lands a huge project. Some months it's crickets. This isn't a simple guess. This single number is a high-stakes gamble. If she estimates too high, she'll get a smaller subsidy than she's entitled to and overpay by hundreds or even thousands of dollars throughout the year. But if she estimates too low, she'll get too much of a subsidy. And when she files her taxes, the IRS will see the difference and send her a bill to pay it all back. A massive, terrifying, unexpected tax bill. This one number could make or break her entire year. How in the world is she supposed to get it right? The answer is, she has to become a fortune teller. Or the next best thing, an expert estimator. This isn't about pulling a number out of thin air. It's about building a number from the ground up, using the same formula the IRS will use when they look at her tax return a year from now. And the secret, the key that unlocks this entire system, is a terrifying sounding acronym, MAGI, MAGI. Modified Adjusted Gross Income. It sounds like something you'd need an accounting degree to understand, but it's not. Think of it like a recipe. You start with your main ingredient, you subtract a few things, you add a couple back in, and what you're left with is the number that determines your fate on the healthcare marketplace. So let's walk through it step by step, just as Sarah would, sitting at her kitchen table with a calculator and a very strong cup of coffee. Step 1 is the biggest, most optimistic number, her gross income. This is every single dollar she expects to earn from her freelance graphic design work for the entire year. Every invoice paid. Every client project, big and small. This is the top line number. Sarah looks at her current clients, her potential leads, and her income from last year. She's been growing steadily. After a deep breath, she projects a gross income of $80,000. It's a bold number, but it feels possible. That's her starting point, $80,000. But of course, she doesn't get to keep all of that. Which brings us to step 2, subtracting her business expenses. This is the cost of being her own boss. Every dollar she spends to run her business reduces her taxable income. And for a freelancer like Sarah, this list is long. The monthly subscription for her design software, the new laptop she had to buy when her old one died, the portion of her internet bill she uses for work, the cost of her website hosting, marketing expenses, online courses to keep her skills sharp, fees for her accounting software, maybe even a portion of her rent if she has a dedicated home office that meets the strict IRS requirements. These aren't just expenses, they're investments in her business, and the government recognizes that. Sarah meticulously goes through her bank statements and projects for the year. She adds it all up: software, hardware, marketing, utilities. She estimates she'll have $20,000 in legitimate business expenses. So, she takes her gross income of $80,000 and subtracts her business expenses of $20,000. That leaves her with $60,000. This is her net earnings from self-employment. This is the profit from her business. It's a much more realistic picture of her income, but we're not at Magi yet. Not even close. Now comes the part that trips up almost every single new freelancer. Step 3, the self-employment tax deduction. When you work for a company, your employer pays half of your Social Security and Medicare taxes, and you pay the other half. It's called FICA tax. But when you're self-employed, you are both the employer and the employee. You have to pay both halves. The whole thing. This is the dreaded self-employment tax, and it's a punch in the gut for anyone new to this world. It's a hefty 15.3% of your net earnings. But here's the crucial silver lining. The IRS knows you're paying the employer's share, and they give you a break for it. They let you deduct the employer portion of your self-employment taxes from your income. This is a huge deal. It's an above-the-line deduction, meaning you can take it even if you don't itemize. So Sarah has to do a little more math. She takes her $60,000 in net earnings. The self-employment tax is calculated on 92.35% of that amount, which is a whole other weird IRS rule, but we'll just follow the formula. So her self-employment tax for the year will be about $8,478. Now she gets to deduct half of that. Half of that is $4,239. She takes her net earnings of $60,000 and subtracts this deduction of $4,239. Her new number is $55,761. This number has a name: Adjusted Gross Income, or AGI. This is the number that most people are familiar with from their tax returns. It's the starting point for calculating most of your taxes. And for the vast majority of self-employed people applying for health insurance, their AGI is going to be incredibly close to their MAGI. Which brings us to the final, and usually the simplest step, for the modification. To get from AGI to MAGI for marketplace purposes, you just have to add back a few specific and fairly uncommon types of income. Things like non-taxable Social Security benefits, tax-exempt interest, and foreign earned income. For Sarah, and for many freelancers, this number is 0. She doesn't have any of those things. So her AGI is her MAGI, $55,761. That's it. That's the number. After all that anxiety, all that math, all that fear of the unknown, she has a real defensible number. It's not a wild guess anymore. It's an educated, calculated projection based on the very same rules the IRS will use. She takes a deep breath and turns back to the healthcare.gov website. She navigates back to the page where it asks for her projected household income. She types in 5-5-7-6-1. She clicks Continue, and the page reloads. The numbers change. Suddenly, a silver plan that was listed at over $400 a month now shows a premium of just over $200. The subsidy, the premium tax credit, has kicked in, and it's substantial. It's not free, but it's manageable. It's a number that fits into her budget. The crushing weight of that potential $1,000 a month premium evaporates. The feeling is pure, unadulterated relief. She can afford to be insured. She can afford to be safe. She has a path forward. She's done it. She's cracked the code. But as she sits there, basking in the glow of her newfound understanding, a new, more subtle anxiety begins to creep in. This number, this $55,761. It's perfect. It's a beautiful, precise estimate, but it's based on a prediction of the future. What happens if she's wrong? What if, in March, she lands a massive, game-changing client that adds an extra $30,000 to her income for the year? Her magi would skyrocket. The subsidy she's claiming every month would suddenly be way too high, and that terrifying tax bill from the IRS would be back on the table. Or what if the opposite happens? What if she loses her biggest client in August and her income plummets? She would then be eligible for a much larger subsidy than she's getting. She'd be overpaying for her health insurance every single month, leaving precious money on the table that she desperately needs. Her income isn't a steady, predictable paycheck that arrives every 2 weeks. It's a roller coaster. It's feast and famine. How do you anchor your health insurance to an earthquake? How do you manage a fixed monthly subsidy when your income is a moving target? Getting the estimate right once is a victory, but the real challenge, the one that separates the pros from the panicked, is learning how to adjust that estimate throughout the year. This isn't just about paperwork. It's about active management of your financial health. Think of it like steering a ship in a storm. You don't just set the rudder once and hope for the best. You make constant, small adjustments to stay on course. Failing to do so can lead you into one of two very dangerous traps. Let's call the first one the cash flow crunch. Imagine you're a freelance web developer. At the start of the year, you're feeling optimistic. You just landed a decent contract, so you estimate your annual income at a healthy $80,000. The marketplace calculates your subsidy based on that number, and it's okay. Not great, but okay. Your monthly premium is, let's say, $400. You grit your teeth and you pay it. January, February, March. But then, in April, that big contract unexpectedly ends. You scramble for new work, but the next couple of months are lean. Really lean. Suddenly, that $400 premium feels less like an expense and more like an anchor, dragging down your bank account when every single dollar counts. You're overpaying for your health insurance based on an income you're no longer making. Now, the good news is, when you file your taxes next year, the IRS will see you made less than you estimated, and you'll get that extra subsidy money back as a larger tax refund. But that doesn't help you now. It doesn't pay your rent in May or buy your groceries in June. You squeezed your cash flow for months when you could have been paying a much lower premium, all because you didn't update your income. That's the cash flow crunch. It's painful, but it's not catastrophic. The second trap, however, is, we'll call this one the tax time bomb. Let's picture a different freelancer, a freelance writer this time. He's just starting out, so he's cautious. He estimates his income very low, maybe $30,000 for the year. Based on this, the marketplace says, congratulations, you qualify for a massive subsidy. His monthly premium is an incredibly low $50 a month. He's thrilled. He's got great coverage for the price of a few fancy coffees. He pays it month after month and doesn't think about it again. But his year turns out to be incredible. A proposal he sent out on a whim gets accepted, and he lands a 5-figure project in July. Then another one in September. By the end of the year, he hasn't made $30,000. He's made $90,000. He's celebrating his success until his accountant calls in March. The news is brutal. Because his actual income was 3 times his estimate, he was not entitled to most of the subsidy he received. The government paid thousands of dollars to his insurance company on his behalf all year long based on that low estimate. And now the government wants its money back. He has to pay back the entire difference. It's called the Premium Tax Credit Clawback, and it results in a sudden, shocking tax bill for thousands of dollars that he was not prepared for. This is the #1 horror story for the self-employed. It's the landmine we all want to avoid. So how do you do it? How do you actively steer the ship? The process is actually simpler than you think. You don't have to wait for open enrollment. You can and should update your income projection anytime it changes significantly. You do this by reporting what's called a qualifying life event. Most people think of these as big things like getting married or having a baby, but for marketplace purposes, a change in your estimated annual income is a qualifying life event. You simply log back into your healthcare.gov or state marketplace account. There will be a button or a link, usually right on your dashboard, that says something like Report a Life Change. You click it. The system will walk you through a series of questions. You'll select the option for an income change, and you'll enter your new, best guess projection for your total annual income. The system will then instantly recalculate your subsidy for the remaining months of the year. If your income went down, your subsidy will go up, and your future monthly premiums will decrease. If your income went up, your subsidy will go down, and your premiums will increase. This might feel painful in the moment, paying a higher premium, but what you're really doing is paying your fair share in real time, disarming that tax time bomb 1 month at a time. The next logical question is, how often should you do this? Daily? Weekly? That would be insane. The best practice, the one that keeps you sane and safe, is to create a recurring financial check-in. Do it quarterly. This is a fantastic habit to build anyway. Many freelancers are already calculating their income and expenses to make quarterly estimated tax payments to the IRS. Just add one more step to that routine. At the end of March, June, and September, sit down, look at what you've earned so far, and reproject for the rest of the year. Did you have a better quarter than expected? A worse one? Take that new data, make a more educated guess for your annual total, and if it's significantly different from your last estimate, take 10 minutes to log in and update it on the marketplace. This quarterly rhythm turns a daunting task into a manageable, predictable part of running your business. Now let's get into the weeds on the most important part of this whole process. What exactly is income to the marketplace? This is where a lot of people get it wrong. They hear income, and they think of their gross revenue, every dollar a client pays them. But that's not it. The marketplace doesn't care about your revenue. It cares about your modified adjusted gross income, or MAGI. For a self-employed person, the starting point for that calculation is your net business profit. That's your gross revenue minus your ordinary and necessary business expenses. This is a game changer. Every dollar you spend on your business reduces the income figure you report to the marketplace, which can increase your subsidy. So what counts? Your home office deduction, the portion of your cell phone and internet bill used for work, the software you subscribe to like Adobe Creative Suite or QuickBooks, the computer you bought, the mileage you drive to meet clients, the fees you pay to a payment processor, the cost of advertising your services, your business insurance. These are all legitimate business deductions that lower your net profit and therefore lower your MAGI. This is why meticulous bookkeeping isn't just good for taxes. It's critical for affordable health insurance. When you do your quarterly check-in, you're not just looking at your bank deposits. You're calculating your profit and loss. You take your total revenue year-to-date, subtract your total business expenses year-to-date, and that gives you your net profit so far. Then you project that out for the rest of the year to get your estimated annual net profit. And remember, your business profit is just one piece of your household's MAGI. You also need to add any other sources of income. If you're married and filing taxes jointly, you must include your spouse's income from their job. You also have to include things like unemployment compensation, capital gains, alimony, or interest and dividends. It's the total household income that matters. Now, there is a small safety net here, but you cannot rely on it. The amount of subsidy you have to pay back isn't always unlimited. If your final income is below 400% of the federal poverty level, which for a single person in 2024 is about $58,000, the amount you have to repay is capped. For very low incomes, the cap can be as little as a few $100s. But the moment your income crosses that 400% threshold, the cap disappears completely. If you estimated you'd make $55,000 but you actually made $60,000, you could go from a repayment cap of a couple $1,000s to being on the hook for the entire $10,000 or $12,000 in subsidies you received. It's a brutal cliff. Managing your income estimate is the secret handshake of the self-employed. It's the difference between feeling in control and feeling terrified of tax season. It transforms the ACA marketplace from a confusing, risky system into a powerful tool you can actively wield to your advantage. But what if you do all this, you master the subsidy system, you find a plan, and it's just not right for you? What if the doctors you want are all out of network? What if the only affordable plans have deductibles so high they feel like you don't have insurance at all? Is the marketplace the only option? For years, that was the conventional wisdom. But the landscape is changing. There are other paths, alternative strategies that exist outside the official exchange. They come with their own set of rules, their own pros, and their own serious cons. And exploring those hidden avenues is exactly where we're going next. So let's step off the official path. Imagine the ACA marketplace is a brightly lit, government-regulated superhighway. It's paved, there are rules, speed limits, and guardrails in place to protect you. But running parallel to it are these older, less-traveled country roads. They're tempting because they look like shortcuts. They promise lower tolls, faster speeds. But they're also filled with potholes, hairpin turns, and zero guardrails. This is the world of non-ACA compliant plans. The first and most common alternative you'll encounter is the short-term health insurance plan. You've probably seen the ads. They pop up online with flashy headlines. Health insurance for just $99 a month. And you, the self-employed entrepreneur staring down a $600 a month premium on the marketplace, you click. Who wouldn't? It feels like finding a secret cheat code for your finances. These plans are exactly what their name implies. Temporary. They were originally designed as stopgap coverage for people in very specific situations, like someone who just graduated college and is starting a new job in 3 months, or someone who is between jobs and just needs to bridge a 60-day gap. They are the spare tire in the trunk of your car. They're not meant for a cross-country road trip. They're meant to get you to the nearest mechanic. The seduction is the price. It is, without a doubt, dramatically lower. And the reason it's so low is the key to understanding its immense risk. An ACA compliant plan is like an all-you-can-eat buffet. You pay a set price and you have access to everything: the salads, the steaks, the desserts, whether you eat them or not. The cost is spread across everyone. Short-term plans are like ordering from an a la carte menu where the restaurant gets to decide, after you've eaten, what they're actually going to charge you for. Here's how they achieve those rock-bottom prices. First, and this is the absolute most critical point to understand, they do not have to cover pre-existing conditions. Let me say that again. They do not have to cover pre-existing conditions. The Affordable Care Act made it illegal for major medical insurance to deny you coverage or charge you more based on your health history. That protection, that fundamental pillar of modern health insurance, is completely gone with short-term plans. And their definition of pre-existing is brutally broad. It's not just a diagnosed illness like diabetes or heart disease. It can be anything you've ever had symptoms for, received medical advice for, or been treated for before your plan started. Did you mention a sore back to your doctor 2 years ago? If you suddenly need spinal surgery, they can comb through your medical records, find that note, and deny your claim, arguing it's a pre-existing condition. Did you feel anxious and talk to a therapist once last year? Your treatment for a major panic attack might be denied. This practice is called post-claim underwriting. They don't dig into your history when you sign up. They do it after you file a big claim, when you are at your most vulnerable, specifically looking for a reason not to pay. It's the ultimate gotcha. Second, they are not required to cover the 10 essential health benefits mandated by the ACA. This is a list of must-haves for marketplace plans. Things like maternity and newborn care, prescription drugs, mental health and substance abuse services, rehabilitative services, lab tests, preventive care like checkups and vaccines. A short-term plan can simply say, "Nope, we don't cover that." So you could have a plan that doesn't cover prescriptions at all, or one that offers zero coverage for mental health. You might be paying a premium every month for a policy that has a giant hole in it right where you need it most. Third, they have coverage limits. ACA plans are forbidden from putting a dollar limit on your annual or lifetime coverage for essential benefits. This is a huge deal. Before the ACA, people would get cancer, their treatment would hit their $1 million lifetime cap, and the insurance company would just stop paying. People lost their homes, their life savings. Short-term plans can bring back those nightmares. They can have annual limits of $100,000 or $1 million or $2 million. $100,000 might sound like a lot of money, but a single serious car accident, a complicated surgery, or a few weeks in the ICU can blow past that number with terrifying speed, leaving you on the hook for the rest. Fourth, the duration itself is a trap. The rules vary wildly by state. Some states have banned these plans entirely. In states that do allow them, federal rules say they can only last for up to 364 days, and you might be able to renew them for up to 36 months total. But here's the catch. Each renewal is a new plan. This means if you get sick, let's say you're diagnosed with cancer in month 10 of your 12-month plan, they will pay for your treatment for the next 2 months. But when you go to renew, your cancer is now a pre-existing condition. They can, and likely will, refuse to renew your policy, or offer you a new one that explicitly excludes any and all cancer-related treatments. You are left with a life-altering diagnosis and are suddenly uninsurable in the short-term market, forced to wait until the next open enrollment period to get back onto an ACA plan. So, who are these plans for? Is there ever a good reason? The answer is, maybe, but the window is incredibly narrow. It's for the perfectly healthy person who is 100% certain they have a qualified ACA plan starting on a specific upcoming date. They are between jobs for 45 days. They need a catastrophic only safety net in case they get hit by a bus. They've read every single word of the exclusion policy, and they understand that if they tweak their knee on a run, that might not be covered if they mention knee pain to a doctor 5 years ago. It is for someone playing a calculated, short-term game of risk management, not for someone looking for reliable, ongoing health coverage. For the average self-employed person looking for a stable, long-term solution, it's like trying to build a house on a foundation of sand. The allure of that low monthly premium is powerful. It preys on our desire for a simple, affordable solution in a system that is anything but. It looks like a lifeline, but more often than not, it's an anchor. It's a gamble where you're betting that nothing serious will happen to you, and the insurance company is betting that it will. And if they lose that bet, they have a dozen ways to avoid paying out. But this is just one of the hidden avenues. There's another path, one that steps even further away from traditional insurance. It's not based on contracts and actuarial tables, but on community, shared values, and faith. It's a world of health-sharing ministries, where members band together to pay each other's medical bills. It sounds revolutionary, almost utopian, a way to care for one another outside the cold, corporate system. But this path has its own shadows, its own deep ravines that are, in many ways, even more perilous. Because with these, you're not even buying insurance. You're buying a promise. And whether that promise is kept is a matter of faith. And I mean that literally. We're talking about healthcare sharing ministries. These organizations have become an incredibly popular alternative, especially for self-employed individuals and families who feel crushed by the weight of traditional insurance premiums. On the surface, the appeal is undeniable. Instead of paying a premium to a massive, faceless corporation, you pay a monthly share into a collective pot with other like-minded members. When a medical need arises, you submit the bill, and the community shares the cost, paying it from that collective pot. Feels different. Feels better. It feels like community, like a return to a time when people looked out for one another. The marketing is brilliant. It speaks directly to the frustrations we all have with the healthcare system. It's filled with images of smiling families, testimonials of gratitude, and a powerful message of faith and mutual support. For a freelance graphic designer in Texas, let's call her Jessica, this was a lifeline. Her ACA marketplace plan was going to cost her over $500 a month with a deductible so high it felt like a joke. A healthcare sharing ministry offered her a monthly share amount of just $200. She was saving thousands of dollars a year. It felt like she'd found a secret backdoor, a way to opt out of a broken system and put her trust in people, not profits. For 2 years it was perfect. She had a few minor doctor visits, paid the small initial amount herself, what they call an unshareable amount, similar to a deductible, and that was it. She was healthy, she was saving money, and she was recommending it to every other freelancer she knew. She was a true believer. But that belief is built on a foundation that most members don't fully understand until it's too late. The single most important thing you need to know about these ministries is this: they are not insurance. This isn't a minor detail. It is the entire game. Because they are not legally considered insurance, they are exempt from all the rules and regulations that actual insurance companies are forced to follow. All those protections that were put in place by the Affordable Care Act, they don't apply here. The requirement to cover pre-existing conditions? Gone. The mandate to cover essential health benefits, like maternity care, mental health services, or even prescription drugs? Not required. The ban on annual or lifetime coverage limits doesn't exist. There is no government agency you can appeal to if they refuse to pay a bill. There is no legal contract that guarantees they will cover your costs. You are relying entirely on the goodwill and the financial solvency of the organization. You are putting your faith in their promise, and that promise is riddled with fine print. Most ministries require members to sign a statement of faith and adhere to a strict code of conduct. This often means no tobacco, no illegal drugs, and limited or no alcohol use. Many extend this to sexual conduct, requiring members to be in a heterosexual marriage to have certain costs shared. If you get into a car accident and it's determined you had a beer with dinner beforehand, they can deny sharing your medical bills. If you have a child out of wedlock, maternity costs may not be shared. They have the right to investigate your life to ensure you are living by their rules. Suddenly, that feeling of community can start to feel like a panel of judges. The biggest landmine of all, however, is pre-existing conditions. Unlike ACA-compliant plans, which cannot deny you for something you had before you signed up, sharing ministries can and absolutely do. They might have a waiting period of 1 to 3 years before they'll share costs for a known condition. Or they might exclude it permanently. The terrifying part is what they define as a pre-existing condition. Some define it as anything you had symptoms of, whether you were officially diagnosed or not, in the 2 years before joining. That high blood pressure you didn't know you had? Pre-existing. Those recurring headaches that turn out to be a brain tumor? They can argue the headaches were a pre-existing symptom. It's a loophole large enough to drive a life-altering medical bill through. Let's go back to Jessica, our freelance designer. In her 3rd year with the ministry, she started experiencing severe abdominal pain. It was sudden and it was terrifying. After a series of tests, she was diagnosed with advanced Crohn's disease, a chronic inflammatory bowel disease. The treatment would involve expensive medications, regular specialist visits, and potentially surgery. The total cost would easily run into the hundreds of thousands of dollars. Jessica submitted her initial bills to the ministry, terrified, but confident that the community she'd been paying into would be there for her. The first denial letter was a shock. They requested her medical records for the past 5 years. They combed through every doctor's note. They found a single entry from 3 years ago, a full year before she joined the ministry, where she mentioned to her doctor that she'd had a sensitive stomach after eating spicy food. That was it. Based on that one single note, they declared her Crohn's disease a pre-existing condition and stated that they would not be sharing the cost for any of her treatments. Period. Her world collapsed. The $300 a month she had saved for 2 years was a pittance compared to the mountain of debt she now faced. The community she believed in was a faceless administrator sending a form letter. The promise she had bought was nothing more than ink on paper. She was uninsured, uninsurable on the open market until the next open enrollment period, and facing a life-changing illness all by herself. Jessica's story isn't an isolated incident. Thousands of similar stories have been reported to state regulators and in news investigations. Families who thought they were covered were left with staggering bills for cancer treatments, emergency surgeries, and newborn care. These ministries can work perfectly for people who are young, perfectly healthy, and stay that way. It's a gamble. You're betting that you won't get sick. You're betting that if you do get sick, it won't be something expensive. You're betting that it won't be something they can link to a stray comment you made to a doctor 5 years ago. And you're betting that the organization itself will have enough money in the pot when your turn comes. For some, that bet pays off. For many others, it leads to financial and emotional ruin. It is the illusion of coverage without the guarantee. But what if you don't fit the lifestyle requirements of a ministry, or the faith-based element just isn't for you? What if you're still desperate for a cheaper option? Well, there's another path in this wilderness. Another type of plan that promises low premiums and immediate coverage. It's not a promise of community, but a promise of speed and simplicity. It's called short-term health insurance. And while it is legally a form of insurance, it operates on a completely different set of rules that can be just as treacherous. It's a temporary bridge. But for many, it's a bridge that leads nowhere. So let's walk across that bridge. Let's see why it's so tempting and where it really leads. Short-term health insurance, sometimes called short-term limited duration insurance, was originally designed for one very specific purpose: to cover gaps. You leave a job, and your new job's insurance doesn't kick in for 60 days. You turn 26 and get kicked off your parents' plan but are waiting for your own open enrollment. It was meant to be a temporary patch for catastrophic events, like a car accident, during a very specific transitional period of life. But in recent years, regulations have changed. What was once a 3-month patch can now, in some states, be sold for a term of up to 364 days, and can even be renewed for up to 3 years. And because these plans exist outside the world of the Affordable Care Act, they are cheap. Unbelievably cheap. You'll see premiums for $80, $90, $100 a month, next to ACA plans that cost 5 or 6 times that. For a self-employed person staring at a budget, seeing that number feels like finding an oasis in the desert. It feels like you've discovered a loophole, a secret the system doesn't want you to know about. This is the siren song of short-term insurance. And it's a song that can lead you straight onto the rocks. Because here is the fundamental, non-negotiable truth you must understand. Short-term plans are cheap for a reason. They don't have to follow the rules. They are not ACA compliant. This isn't just a small detail. It is the entire game. Remember the 10 essential health benefits we talked about? The bedrock of modern health insurance? Ambulatory patient services, emergency services, hospitalization, maternity and newborn care, mental health and substance use disorder services, prescription drugs, rehabilitative services, laboratory services, preventive and wellness services, and pediatric services. An ACA plan must cover these things. A short-term plan does not. Most short-term plans cover a few of these, like emergency services and some hospitalization. But the rest? It's a free-for-all. Many offer zero coverage for mental health, zero coverage for maternity care, zero coverage for prescription drugs. They can, and often do, simply write these things out of the policy. So you pay your $100 a month feeling protected. Then you get a prescription for a common but expensive medication, and you arrive at the pharmacy counter only to be told your insurance covers nothing. The bill is $400. Your monthly savings have just been vaporized in a single transaction. But that's not even the biggest danger. The real trap, the foundational deception of this entire market, lies in two words: medical underwriting. When you apply for an ACA plan on the marketplace, they can ask you your age, your zip code, and if you use tobacco. That's basically it. They are legally forbidden from asking about your health history. They cannot deny you or charge you more because you have diabetes or asthma, or had cancer 5 years ago. This is the cornerstone of the Affordable Care Act. The protection for pre-existing conditions. Short-term insurance operates in the pre-ACA Wild West. Not only can they ask about your health history, they require it. This process is called medical underwriting. They will have you fill out a long questionnaire about every ailment you've ever had. And based on your answers, they can do one of three things: approve you, charge you a much higher premium, or most likely flat-out deny you coverage altogether. If you are anything less than perfectly healthy, you probably won't even be able to buy one of these plans. But let's say you are. Let's say you're 30 years old, you run, you eat well, you have no known health issues. You get approved. You start paying your $95 a month. You feel like you beat the system. This is where the trap springs. A few months into your plan, you start having persistent stomach pain. You go to the doctor. After a few tests, they diagnose you with Crohn's disease, a chronic inflammatory bowel disease. It's serious. It's going to require ongoing care, expensive medications, and regular procedures. You submit the claims to your short-term insurance provider, and a few weeks later you get a letter. It's a rescission notice. Your policy has been canceled, effective immediately, and they're not paying for any of your treatment. They are retroactively denying all of it. You are now on the hook for tens of thousands of dollars in medical bills, and you have no health insurance. What happened? They went hunting. After you filed that first big claim, the insurance company launched an investigation into your medical history. This is called a post-claims underwriting, or a look-back. They subpoenaed all of your medical records from the last 5 or 10 years. And they found it. A single note from a doctor you saw 2 years ago for a routine checkup. You'd mentioned some occasional indigestion. The doctor wrote in your chart, patient reports mild, intermittent dyspepsia, advised dietary changes. To you it was nothing. To the insurance company, it's their golden ticket. They will claim your new diagnosis of Crohn's disease is related to that pre-existing condition of indigestion. They will argue that you failed to disclose it, or that the condition secretly existed before you bought the policy. And because these plans are built to protect the insurer, not the insured, they will almost always win. The fine print in your contract gives them the right to do this. This is the business model. It's not a bug, it's the feature. They collect premiums from the healthy, and when someone gets sick, they deploy a team of experts to scour their past for any excuse, no matter how flimsy, to deny coverage and cancel the policy. They are betting you won't get sick. And if you lose that bet, they wash their hands of you. Gets worse. Short-term plans are riddled with exceptions and limits that would be illegal in an ACA plan. Many have annual or lifetime dollar limits on coverage. Your plan might say it covers hospitalization, but if you read the fine print, it only covers up to $100,000. A serious multi-day hospital stay can easily exceed that, leaving you to pay the rest. They might have specific dollar limits per doctor visit, or per day in the hospital. They can exclude coverage for common injuries like those from sports, skiing, mountain biking, even just playing in a local softball league. If you get hurt, you might find your policy won't cover it because it's a hazardous activity. You are buying a product that is designed to look like health insurance, to be marketed like health insurance, but to fail you the moment you actually need it to function like health insurance. It's a healthcare disaster avoidance product for people who are betting they won't have a healthcare disaster. So, is there ever a time to consider one? The answer is almost never. The only conceivable scenario is for a true, catastrophic, only very short-term gap. For example, you are 100% certain your new job and its excellent insurance plan starts on July 1st, and your old coverage ends June 1st. You have a 30-day gap. You could buy a 30-day short-term plan as a hedge against a truly random, unpredictable accident. A falling piano, a lightning strike, a major car crash. But even then, you are accepting a colossal risk. You are accepting the risk that a dormant illness could suddenly appear during that 30-day window, be labeled a pre-existing condition, and bankrupt you. For the self-employed who are looking for a stable, reliable solution for the long term, this is not a solution. It is a mirage. The bridge to nowhere is actually a more sinister structure. It's a bridge that's been intentionally engineered to collapse the moment you put any real weight on it. It's designed to hold the weight of your monthly premium, and nothing more. So if the cheap bridge is a trap, and the ACA marketplace feels like a toll road you can't afford, is there another path? A secret passage that the financially savvy have been using for years? There is. And it's built around three powerful letters. H, S, A. H is A, the health savings account. Now I know what you're thinking. A savings account? That's the big secret? I have a savings account. It earns about $1 a year in interest, and doesn't help me when I'm staring down a 4-figure medical bill. And if that's what you're thinking, you are completely, totally, and understandably wrong. Calling an HSA a savings account is like calling a smartphone a pocket calculator. Technically does that, but you're missing the entire point. An HSA is not a savings account. It's a financial Swiss Army knife. It's a retirement account on steroids. It is, without exaggeration, the single most powerful tool for managing healthcare costs and building wealth available to self-employed Americans today. And most people have absolutely no idea how it really works. The power of the HSA is built on a concept so good it sounds illegal. It's called the triple tax advantage. Not a single tax advantage like a 401k. Not a double tax advantage like a Roth IRA. Triple tax advantage. This is the holy grail of financial planning, and it's hiding in plain sight inside our healthcare system. Let's break it down. First, the money you put into your HSA is tax deductible. This is an above-the-line deduction, which is tax nerd speak for the best kind. Let's go back to Sarah, our freelance designer earning $60,000 a year. Let's say in 2024, she decides to contribute the maximum for an individual, which is around $4,000 into her HSA. When she files her taxes, the IRS doesn't see her as having earned $60,000 anymore. They see her as having earned $56,000. Poof! $4,000 of her income just became invisible to the tax man. She instantly saves over $1,000 in federal and state taxes, just by moving money from her checking account to her HSA. That's advantage number one. Second, the money inside the HSA grows completely tax-free. This is the part that separates the rookies from the pros. Most people think the money just sits there like in a regular savings account. But that's not true. Most HSA providers allow you to invest your HSA funds. You can buy stocks, bonds, mutual funds, ETFs, the whole 9 yards. And every single penny of growth, the dividends, the capital gains, is 100% tax-free. Forever. Think about that. It's like having a secret Roth IRA that's specifically for your health. Over 10, 20, or 30 years, this tax-free growth is astronomical. It's the difference between a small pile of cash and a genuine mountain of wealth. That's advantage number two. Third, when you take money out to pay for qualified medical expenses, the withdrawal is, you guessed it, completely tax-free. No income tax. No capital gains tax. Nothing. You can use it to pay for your deductible, your co-pays, prescriptions, dental work, new glasses, chiropractic care, even acupuncture. The list of qualified expenses is massive. So, let's recap the magic trick. The money goes in tax-free, it grows tax-free, and it comes out tax-free. You literally never pay a single cent of tax on this money from start to finish as long as you use it for healthcare. Now you're probably thinking, this sounds too good to be true. What's the catch? And there is one. But it's less of a catch and more of a key. To unlock the power of an HSA, you need a specific type of health insurance plan. A high-deductible health plan, or HDHP. The government basically makes a deal with you. They say, look, we'll give you access to this unbelievable tax-sheltered investment vehicle, the HSA. In exchange, you have to take on a little more of the initial risk in your healthcare by choosing a plan with a higher deductible. For years, people have looked at the words high deductible and run for the hills. They see it as a negative, a scary number they might have to pay. But for the self-employed, this is a feature, not a bug. Why? Because HDHPs almost always have significantly lower monthly premiums than traditional, low-deductible plans. Think about it. Instead of paying, say, $600 a month for a low-deductible plan, you might pay $350 for an HDHP. That's $250 in cash flow you get back every single month. That's $3,000 a year. What can you do with that extra $3,000? You can funnel it directly into your HSA. You are literally taking the money you would have given to the insurance company and paying yourself instead into a tax-free investment account that you own and control forever. The plan is designed to fund the tool. The lower premium of the HDHP is the fuel for your HSA rocket ship. You use the HSA to cover your high deductible if you need to. That's its primary job. But this is where the mindset shift has to happen. The goal isn't just to use the HSA to pay for this year's doctor visit. The goal is to turn it into a long-term medical nest egg. The real pro move, if you can afford it, is to pay for your current, smaller medical expenses out of pocket with after-tax money, and let your HSA balance grow and compound untouched for years. Why would you do that? Because of the investment engine we talked about. Let's run a simple scenario. You contribute $3,000 a year to your HSA for 30 years. If you just let it sit in cash, you'll have $90,000. That's great. But if you invest it and get a modest 7% average annual return, do you know what you'll have? Over $300,000. All of it, every last cent, available completely tax-free for medical expenses. That's the power of tax-free compound growth. But here's the final mind-blowing secret that makes the HSA the undisputed champion of all retirement accounts. What happens if you get lucky? What if you stay healthy and you hit age 65 with a massive six-figure HSA balance you've barely touched? Did you just lock all that money away where it can only be used for healthcare? No, the rules change. Once you turn 65, your HSA essentially becomes a traditional 401k or IRA. You can pull money out for any reason you want, a vacation, a new car, spoiling your grandkids, and you'll just pay regular income tax on it, exactly like you would with a 401k withdrawal. There are no penalties. It just becomes a normal retirement account. But, and this is the kicker, if you do use it for medical expenses in retirement, which, let's be honest, are often people's single biggest expense, it remains 100% tax-free. No other account does this. A 401k is taxed when you pull it out. A Roth IRA is tax-free on the way out, but you pay taxes on the way in. The HSA is the only vehicle on the planet that gives you a tax deduction on the way in, tax-free growth in the middle, and tax-free withdrawals for healthcare on the way out, with the flexibility to become a regular retirement account as a backup plan. It is the perfect financial tool, a safety net for today, an investment for tomorrow, and the ultimate retirement healthcare solution. It transforms your health insurance from a pure expense into a powerful asset-building machine. So the question shifts. It's no longer, can I afford health insurance? It becomes, how do I build the optimal system using a low-cost HDHP to unlock a wealth-generating HSA? This is the path forward. This is how you escape the trap of overpriced plans and build true financial security as a self-employed person. But knowing the destination is one thing. Having the map is another. How do you find these plans? Which companies offer the best HSAs for investing? And what are the hidden fees and traps you need to watch out for when you're setting this all up? Because if you choose the wrong provider, you could lose thousands in fees and miss growth. Building this system correctly is the final critical piece of the puzzle. The first and most insidious trap is the one that looks the most convenient. Your local bank. You walk in, you have a checking account there, and they say, hey, we can set up an HSA for you right now. It's free. And it sounds perfect. It's easy. But this is the classic bait and switch. That free account often comes with an asterisk the size of a medical bill. They might not charge a monthly maintenance fee, but they'll hit you with everything else. A fee if your balance dips below a certain amount. A fee for issuing a debit card. A fee for writing a check. A fee for transferring money out. And worst of all, their investment options, if they even exist, are a complete joke. You'll be offered a handful of their own proprietary, high-fee mutual funds that barely keep up with inflation. It's like getting a free car, but you're only allowed to drive it in their parking lot, and the gas costs $50 a gallon. They are counting on your inertia. They know that once your money is in, you're unlikely to go through the hassle of moving it. They're not selling you a wealth-building tool. They're selling you a glorified, low-interest savings account disguised as an HSA, and they're charging you for the privilege. The second major trap is what I call the investment black hole. This is common with HSA providers that are bundled with insurance plans or run by payroll companies. Their primary business isn't helping you grow your money. It's processing claims or payroll. The HSA is just an add-on. As a result, their investment platform is an afterthought. It's clunky, confusing, and filled with a minefield of high-cost mutual funds. We're talking expense ratios of 1%, 1.5%, or even higher. Now, that might not sound like a lot, but let me show you why that's financial poison over the long term. Let's say you're 35, and you contribute $4,000 a year to your HSA until you're 65. With a good, low-cost provider, you invest in a simple S&P 500 index fund with an expense ratio of, say, 0.03%. Assuming an average 8% annual return by age 65, your HSA would be worth over $510,000. Now, let's run the exact same scenario, but with a bad provider charging a 1.2% expense ratio. That single, seemingly small difference in fees will vaporize over $100,000 from your account. By retirement, you'd have less than $410,000. $100,000 gone. Not because of a market crash, not because you made bad investment choices, but simply because you chose the wrong administrator. It's a silent tax that bleeds your account dry year after year. They are robbing you of your future financial freedom, 1 basis point at a time. The third trap is the Hotel California provider. You can check out anytime you like, but you can never leave. Or at least, they make it incredibly painful to. These providers lock you in with exorbitant account closure fees, transfer fees, or by creating a bureaucratic nightmare to move your money. They'll require you to print forms, get them notarized, and mail them in via certified mail, hoping you'll just give up. This is critically important because the best HSA provider today might not be the best one in 5 years. You need the flexibility to move your money to a better platform if one emerges, without paying a king's ransom to do so. Your HSA is your money. You should be able to move it whenever you want, with a few simple clicks online, not by navigating a maze of paperwork designed to hold you hostage. So, how do you avoid these traps? You look for what I call the HSA trifecta. This is the 3-part checklist that separates the world-class providers from the predators. Number 1, no or low fees. The best providers charge 0 monthly maintenance fees. 0 fees to open or close an account. They don't require a minimum balance. Their fee structure is simple, transparent, and built around a single philosophy. Let you keep as much of your own money as possible. Number 2, excellent investment options. This is non-negotiable. A great HSA provider gives you access to a full-service brokerage window. This means you can invest in almost anything you want. Low-cost index funds, ETFs, individual stocks. You want the same freedom and low-cost options you'd find in a top-tier 401k or IRA. You're looking for providers whose primary business is investing, not banking. Companies like Fidelity or dedicated HSA specialists like Lively are often lauded for this because they understand that an HSA isn't just a health account, it's a retirement account in disguise. And number 3, a modern user-friendly platform. Life is complicated enough. Managing your healthcare funds shouldn't be. The best providers have a clean, intuitive app and website. It should be effortless to contribute money, track your investments, and most importantly, reimburse yourself. You should be able to snap a photo of a receipt with your phone, upload it, and have the money transferred to your bank account within a day or 2. If the interface looks like it was designed in 1998, run. Finding a provider that nails this trifecta, low fees, great investments, and a simple interface, is the final step. It's how you transform your HSA from a simple spending account into a powerful, tax-free, wealth-generating machine that will serve you for the rest of your life. And with that, we've done it. We've reached the end of this journey. Just think about where we started. For many of you, health insurance was a black box, a source of anxiety and confusion. It was this giant, intimidating monster lurking in the shadows of your self-employment dream. You were navigating a system that felt rigged against you, filled with confusing jargon like deductibles, coinsurance, and out-of-pocket maximums. You were worried about the subsidy cliff, afraid of picking the wrong plan, and maybe even felt like giving up on your business just to get a stable W-2 job with benefits. But look at you now. You're not just a survivor of this system. You are the architect of your own. You understand the metal tiers not as confusing labels, but as strategic choices about risk and cash flow. You know how to navigate the marketplace, how to calculate your subsidies, and how to legally manage your income to maximize the help you receive. You've learned that the sticker price of a plan is rarely what you pay, and that sometimes a silver plan can be better than a gold one. You've looked beyond the traditional system, exploring powerful alternatives like direct primary care and health-sharing ministries, realizing you have more options than you ever thought possible. You've learned how to build a safety net that isn't dependent on any single insurance company. And most importantly, you have unlocked the ultimate cheat code, the health savings account. You now see it not just as a way to pay for doctor's visits, but as a triple tax-advantaged investment vehicle. A stealth IRA, a tool to build generational wealth that can fund not only your healthcare and retirement, but your entire retirement itself. You know how to choose the right provider and avoid the traps that snare so many others. You have traded confusion for clarity. You have replaced anxiety with a plan. This was never just about insurance. It was about freedom. The freedom to stay self-employed without being terrified of getting sick. The freedom to build your business your way on your terms. The freedom to know that you and your family are protected not by a faceless corporation, but by a system that you designed, you control, and you understand. The power is now in your hands. You have the knowledge. You have the playbook. Go back, rewatch the parts that you need to, use this guide as your foundation, and build the health and financial security that you deserve. You are a creator, an innovator, an entrepreneur. You are the engine of the economy. You are no longer just a freelancer, a consultant, or a small business owner. You are the CEO of your own life. And now you have the healthcare strategy to prove it. Go build your empire.